Greetings everyone. Today we come to the next session. After understanding the basics about the income from house property, basics means what will be considered as property and so on. Now we move on to the next part, that is how we or what are the steps to compute the income from house property. Uh, in the previous session, we learned about that what are the basic criteria to be taken into consideration, what are the exemptions to be taken into consideration, what to and what not to include as income from house property. Now we come down to, once the decision is taken up, how or what steps we have to follow in order to compute the income from house property. So there can be three different types of house properties for the purpose of taxation under the head income from house property. First will be the let out property, that is, it is given on rent. The second, self-occupied house property, that is, if the properties are used for or used by the owner himself for residing, a residential purpose, or maybe it can be used for both, that is a self-occupied as well as maybe rented out. And then there is a third category, that is deemed to be let out property. That is, if more than two properties are used for own residential purpose, only two houses according to the choice of the taxpayer, the choice is given to him, will be treated as the self-occupied properties, and the other houses will be treated as deemed to be let out, and their income from house property will be computed accordingly. So here, first of all, first we have to check out what is the actual use of the property, whether it is used or occupied by self, or it is rented out, or it is done partly. Once done this, coming to this, we have to understand, because we are talking about, because now we have to, it is income from house property will depend upon the annual value of the house. Now first let us understand the meaning of the annual value, and then we will learn how to compute that annual value. As per section 23(1) para 1 subpara A, the annual value of any property shall be the sum for which the property might reasonably be expected to be let out from year to year. It may neither be the actual rent derived nor the municipal valuation of the property. It is something like notional rent, which could have been derived had the property been let out. In determining the annual value, there are four factors which are normally taken into consideration, and those four factors are actual rent received or receivable, the municipal valuation of that property, the fair rent of that property, and also the standard rent. How to calculate the income from house property? Coming to this, if we talk about that, we will say that first we will have to determine the gross annual value of that property, and for determining the gross annual value, we have to first take into consideration, or we have to first check out whether it is a let out or self-occupied, or it is deemed let out property. So suppose if it is self-occupied property, in that case the gross annual value will be taken as 0. If it is a let out property, then in that case the let out property, in that case the rent, we have to calculate the rent obviously of that property. Gross annual value will be computed systematically for that. And for deemed let out property, in that case gross annual value is the market value of the rent that is received. So there is a procedure, we'll be following this, we'll understand it. So once we determine the gross annual value or calculate the gross annual value, we then reduce this gross annual value by property tax. That is, whatever taxes which has been paid, it is allowed as deduction from the gross so the value of the the gross annual value so computed or derived will be reduced or deducted by the property amount of property tax. Now, the property tax which the owner pays during the previous year are only there, that is the only amount that will be allowed to be deducted to arrive at the net annual value. This deduction can be claimed even if it pertains to the to preceding financial year in the to preceding financial year in this financial year. It is allowed even when the property is left vacant for the past year. So if the property taxes are paid by tenant, the deduction cannot be claimed by the owner. Only the sum owner paid can be claimed as deduction. Once we arrive at the formula for the net annual value can be gross annual value minus the property tax or minus the municipal taxes. After that, there is a standard deduction of 30% that is allowed to be reduced from the net annual value. Net annual value, so we can say that net annual value is allowed as a standard deduction from the net annual value under section 24 of the Income Tax Act. No other expenses such as maybe painting, repairs, etc. can be claimed as tax relief beyond 30% cap under this section. So you can claim 30% of expenses deduction even if you have not actually incurred those expenses. So overall 30% of a standard deduction is allowed to be deducted from the net annual value. After that, if you have taken some loan to build your house or for that house property, that is also allowed as deduction. So a deduction under section 24, it says, is also available for interest incurred on a housing loan used to purchase or maybe to construct the property. In the case of construction, however, the interest deduction is available only after the completion of the construction. After that, I think we arrive at the income from house property because this resulting value after the standard deduction and loan interest amount, this is tax at the slab rate which is applicable to you. In case you are opting for new regime or interest deduction on housing loan is available only in case of let out property. Yes, this is an important point that has to be kept in mind, that in case you are opting out the new regime, then interest deduction on housing loan is available only in case of let out property. Okay, then next we have then the next step, if it is a loss, they can be, because maybe if it is, suppose your house you are occupying yourself and but you are paying the municipal taxes, you are paying the home loan interest, which are allowed to be deducted, so this will be considered as a loss on. So always it is not necessary that always we have a income from house property. It may be loss from the house property. So when you own a self-occupied house, since its gross annual value is nil, claiming the deduction on home loan interest will result in a loss from house property. This loss can be adjusted against the income from other heads also. So this is how, these are the steps we follow to compute the income from house property. There are some important points that must be kept in mind, important notes that must be kept in mind. That is, it allows, because the Income Tax Act, it allows a taxpayer to set off the losses from one head of income against the income from another head. But we have to follow certain restrictions or certain measures have to be taken up. So let us first understand them also. Set off against income from house property. That is, if you have to, what is the situation when you have to set off from the same head? Because there is no restriction on setting off house property loss against the house property income in the same financial year. That means that if you have two properties, suppose, one generating the rental income and another resulting in a loss, maybe, then the loss of one property can be adjusted against the income of the other house without any limits. There are no amount brackets for that. Second is that you are also allowed to set off against the income from other heads. If suppose your income from house property does not fulfill that amount of loss, suppose the loss is rupees 10,000 and the gain from the other property is suppose 5,000. So you can write off only till 5,000 and the loss is still standing to amount 5,000. So maybe here there is a restriction here or a controlling figure here. A maximum of rupees 2 lakhs of loss under the head income from house property can be set off against the income from other heads. For example, it can be written off against salary income, it can be set off against business or profession income, it can be set off against capital gain as well as income from any other sources. But it should not go beyond rupees 2 lakh. This restriction was introduced in the assessment year 2018-19 onwards. Okay, so first choice is that you have to write off the losses, set off the losses from the income from house property itself if it is available. If not, in that same year you can write it off from the income from other heads also, but the limitation is to rupees 2 lakhs. Then suppose still the loss is standing. In that case, what can you do? Carry forward of you can carry forward the house loss of the house property as per section 71B. If the loss from the house property cannot be fully set off in the current year because it exceeds rupees 2 lakh, in that case the unadjusted balance will be carried forward for the following 8 assessment years. So you are allowed to write it off or set it or carry it forward till 8 assessment year till that amount is completely set off. However, in subsequent years, the carried forward loss can be set off only and only income from house property and no other head. You cannot do it against salary, you cannot do it against business income, capital gain or income from any other source. Okay, so it cannot be done against any other head. Then the rental value of the let out property, that is when the house is let out, its gross annual value forms the basis for computing the income. So the actual rent received or receivable by the owner and the reasonable rent, that is fair rent, that is the rent a similar property in the same area would generate or fetch, is determined by the local municipal valuation or rent control act. So this is this is a note when the property is let out, not for the self-occupied house. So here we have to take into consideration or comparative amount has to be done on the basis of the fair rent, municipal valuation, etc., etc. However, if the actual rent is received is less than the reasonable rent due to vacancy or non-recovery, that is unrealized rent, then actual rent may be considered. Okay, so these are some important notes that must be kept in mind while carrying forward or maybe writing off or setting off the losses, and also in case of if the property is let out. How to calculate now the steps that are there, how we decide that let me put it more, because here we have to take into consideration the municipal value, the fair value, etc., etc. So the first, we are taking the first category, that when the property is let out. In that case, how do we calculate? First step is you find out the reasonable expected rent of that property. Okay, how will we find out the expected rent? Let us decide this. First, we will make a comparison between the fair rent and the municipal value. We compare the municipal value and the fair rent, and whichever is higher will be whichever will be higher will be will be picked up. Okay. For example, I'll just show you. Suppose if first we will take up two things, that is municipal value or fair rent, and out of the two we will compare whichever is higher. That amount is picked up. Okay, and that will be compared with the expected rent, or with the standard rent, in order to decide the expected rent. Okay, so here we have the municipal value or the fair rent. Once it is picked up, then we go for the we'll compare that value with the standard rent. Okay, and whichever is lower will be taken as the expected rent, because here we should know that it cannot go beyond standard rent. The value cannot go beyond standard rent. So to explain, we can say expected rent, it is deemed to be the sum for which the property might reasonably be expected to be let out from year to year. And when we need what is fair rent? Expected rent is deemed to be the sum for which the property might reasonably, whatever we expect. But what is fair rent? Fair rent, it is the rent which is fetched by the similar property in the same or maybe similar locality. And what is standard rent? It is the maximum rent which a person can legally recover from the tenant under the Rent Control Act. So therefore, first step is the most important, that is we have to find out the expected rent. How do we do it? We pick up the municipal value and we take the fair rent, we compare, whichever is higher will be picked up, and then we compare it with the standard rent, and out of the two, whichever is lower will be taken up as the expected rent. Once it is done, we decide, then the second step is to find out the rent actually received, then actual rent. We will compare it with the actual rent. So we find out actual rent, which is after excluding or deducting the unrealized rent. Unrealized rent means the rent which is not paid by the tenant yet, but before deducting the loss due to vacancy. So then we again out of the two, out of the standard and the actual rent, we compare these two, and whichever is higher will be taken into consideration. Higher of the amount will be taken up. Now here, then we will compute in the next step the loss due to vacancy, and after deducting that loss, that is loss due to vacancy, after deducting that we get the gross annual value, GAV. So this is how, these are the steps that are followed in order to come down to the GAV. Let us just check out this rent actually received or receivable. That is, how do we we have to keep some important points also regarding the rent actually received or receivable. Actual advance rent cannot be rent received or receivable of the year of received. And if the tenant has undertaken to bear the cost of repairs, in that case the amount is spent by the tenant cannot be added to rent received or receivable. And tenant share of municipal tax realized from the tenant cannot be added to actual rent received or receivable, as it is the occupier's duty to pay the municipal tax. So this is how so let me just summarize this on this chart, that the first step is, with the help of this chart, whatever we discussed just now, I'll just summarize it here. It is the fair rent or the municipal value, whichever is higher, first picked up and kept it aside. After that, we will compare it to whatever figure is picked up from the step 1. In step 2, we'll compare that figure with the standard rent. Whichever is lower will be called the expected rent, and that is the expected rent. Now, expected rent will be compared with the actual rent. Now, when actual rent is higher, it will be the gross annual value. Okay, when actual rent is higher, it will be higher than the expected rent, it will be your gross annual value. That actual value will be the gross. But in case if the actual rent is less than the expected rent, in that case, because here unrealized rent can be reduced from the actual rent if conditions of Rule 4 are satisfied. In that case, we have two situations to consider. The first is if the actual rent is less than expected rent due to vacancy. Vacancy means, unrealized rent and vacancy are two different situations. Vacancy is when you have rented it out, there was a person who took it, your tenant was there for maybe suppose 8 months, and for the another 4 months nobody took it on rent. Nobody took the house on rent. So in that case, in this case, you will have to understand the vacancy part. And what is unrealized rent? It is when it is on rent for the whole year, but the tenant has paid only for 10 months and he is not paid the rent for 2 months, but he used the house. So this is the difference. So in case if this vacancy is due to, this actual rent is less than expected rent due to vacancy, then your actual rent becomes the gross annual value for further calculation. And the second situation is when the actual rent is less than expected rent because of any other factor, maybe because of being unrealized rent or anything else. In that case, whatever the expected rent will be taken up as the gross annual value. I hope this is clear. So once you have decided what the expected rent is, and you compare it with the actual rent, which will be the gross annual value, will depend upon the situations. There are 3 situations. One, if the actual rent is higher than the expected rent, gross annual value is that actual rent. But since there was maybe vacancy or unrealized rent due to which the actual rent is less than the expected rent, in that case, if it was because of vacancy, in that case whatever the actual rent is, that becomes the gross annual value. And in the second case, any other reason, the expected rent becomes the gross annual value. I hope this is clear. Coming to understand more about the unrealized rent. Unrealized rent is the rent which the owner could not realize. Unrealized rent of earlier years is not deductible. Only unrealized rent of the current previous year is deductible. It shall be excluded from the rent received or receivable only if the following conditions are satisfied. the conditions of rule 4, as as it was put on the chart also, that is if it will satisfy. What are the conditions of rule 4? Conditions of rule 4 says that the tenancy has to be bona fide, the defaulting tenant has vacated or steps have been taken to compel him to vacate the property. The defaulting tenant is not in occupation of any other property of the SSE. And the fourth important point is the SSE has taken all reasonable steps to institute legal proceedings for the recovery of the unpaid rent, or satisfies the assessing officer that legal proceeding would be useless. So these conditions must be satisfied before deciding the amount or the for the unrealized rent. Then coming to the municipal tax, because from the gross annual value once decided, we are allowed to deduct the municipal taxes. Municipal taxes are like any other house taxes. For example, there can be a house tax, there can be a service tax, which is levied by any local authority in respect of the house property. They are deductible only if these taxes are borne and actually paid by the owner during the previous year. It doesn't matter whether the municipal taxes paid during the previous year belong to the earlier past years or current years or previous years or coming years. So this tax is allowed to be deducted after the gross annual value is decided. Then another thing, that is the standard deduction, another point that is also allowed to be deducted, 30%, as we said. It is as per section 24 para A, 30% of net annual value, whatever is computed, it is deductible irrespective of any expenditure incurred and not by the SSE. Means whether this expenditure is incurred or not incurred by the SSE, it is allowed to be deducted. Thus, no deduction can be claimed in respect of expenses on insurance, ground rent, land revenue, repairs, collection charges, electricity, water supply, salary of liftmen, etc. If the owner of the house occupies more than one house for his residential purposes, then except one house on which a standard deduction is allowed, but on all other houses which is treated as deemed to be let out houses, no standard deduction will be allowed. So we discuss this much today. We will continue in the next session. Thank you.